As everyone's finishing coming in, I'll kick things off and say good afternoon and welcome to our first session of the 2026 Yellow Book Training Series. I'm Rachel Windett with Sikich University, and I'm also joined by Rachel Hawley, who will be here to help screen questions and comments as they come in. As I had previously noted, we do have a materials attached, so take a moment and download those via the icon at the top of your screen. For today, CPE, we will have 3 polls. So they will pop up throughout the session. Make sure that you complete all 3 of those polls for CPE credit. If you're joining us via the browser, just make sure you're set to full screen, as if it's minimized, it could be, the polls can be hidden. And as a note with CPE certificates, your certificate will come from certificate@conferences.io. I mentioned that as it can get held up in your spam folder, so do keep an eye out for that. So this recording will be made available on demand in a few days. You will see an email with that information. But for this session, we're welcoming back Kellen O'Malley and Lindsay Fish. Kellen is an audit director at Sikich here, where he began his career in 2016. He provides assurance and advisory services to a variety of clients in state and local government. And Lindsay is an audit principal with us, where she actually began her career in 2013. Lindsay provides assurance and advisory services to a variety of municipalities, counties, community colleges, park districts, school districts, and all other special districts. So thank you again for joining us, and I will officially hand things over to Kellen and Lindsay.
Okay, thank you. Good afternoon, everyone, and welcome. So we're excited today to kick off the first of our 2026 Yellow Book webinar series. We're at session 1 today on preparing an annual comprehensive financial report, or an ACFR, as you'll hear us refer to it throughout the presentation. So today's webinar is designed for really anyone in local government who plays a role in financial reporting, compliance, and audit preparation. So whether you oversee the entire reporting function, or you're hands-on preparing schedules, reconciling accounts, drafting note disclosures, or coordinating with auditors, this content is meant for you today. So preparing an ACFR is a team effort, and strong financial reporting depends on coordination across multiple roles within the finance department. Our goal throughout this series and today as well is to provide practical and actionable guidance that you can apply immediately within your local government. So whether that means improving internal processes, strengthening documentation, enhancing internal controls, or simply gaining greater clarity around requirements and expectations. Before we dive in on today's specific webinar on preparing an ACFR, we'd just also like to strongly encourage you to register for the full 2026 webinar series. So shameless plug here on some upcoming sessions that will address some critical topics, including fraud prevention, ethics, single audit updates, cybersecurity risks, reporting deficiencies, and GASB updates. So a lot of exciting topics coming up. So with that, let's get started on today's focus, preparing a strong and well-structured ACFR. We already went through me and Kellen's information, so I'll skip over that one. So before we jump into the content, I did just want to give some objectives and clarify what you're going to walk away with after today's session. So at the end of the session, you should have a clear understanding of the purpose and structure of the ACFR. So not just what goes into it, but why it matters from a transparency, accountability, and governance perspective. As we know, the ACFR isn't exactly light bedtime reading, but it is one of the most important documents your organization produces. You'll also be able to identify key planning considerations and common challenges that can slow down the process or increase the audit risk. And many of these issues aren't necessarily technical accounting problems. Sometimes they're just timing, coordination, or documentation challenges. And then finally, you'll gain practical best practices that can make your ACFR preparation more efficient and just a more controlled process. So the goal isn't not only to produce a compliant report, but also we would like to, this session should help reduce stress, minimize surprises, and improve the overall quality of your financial reporting process as a whole. And then here's how we'll get there. We're going to start with a high-level overview of the ACFR to really ground the discussion on its purpose and framework. And then we're going to walk through each major section of the report. So we're going to walk through the introductory section, the financial section, and then the statistical section as well. And then after we've covered the structure of the report itself, we'll shift gears and more talk about the process. So talking about planning, risk management, and audit coordination. So this is kind of where we'll connect the dots between the technical requirements to the operational realities of preparing your document. We're going to close with some key takeaways so you leave with a clear set of action items. So really we'll move from structure to execution to strategy. So with that, we're going to start with our first polling question. How early does your organization begin ACFR preparation? We've got before fiscal year end, immediately after fiscal year end, during audit fieldwork period, or near the reporting deadline. No wrong answers here, just looking for how early does your organization begin ACFR preparation?
And a friendly reminder that this poll is required for CPE credit. So if you're looking for that credit, make sure you get your response in. We're at about 88% replied. I'd like to get to 90. Okay, I'll close the poll.
Okay, we got, yeah, about 90% of you replied. So before fiscal year end is 42%, immediately after fiscal year end, 26%, during the audit fieldwork period, 27%, and 5% near the reporting deadline. So hopefully by the time we're done with our presentation today, some of those answers might change a little bit when you hear some of our key takeaways today. So from there, I'm going to hand it over to Kellen, and he's going to talk about the ACFR overview.
Thank you, Lindsay. So as we get into ACFR overview, this section is meant to kind of level set before we get into the details. I want to kind of ground us in what an ACFR is, why it matters, how it's structured, because many ACFR issues trace back to misunderstanding this. So we'll start high level, then we'll move into the introductory and financial sections before I turn it back to Lindsay to cover the statistical section. So you can go to the next slide. An ACFR is a comprehensive financial report document issued by many governmental entities. So the Governmental Accounting Standards Board, GASB, sets the accounting and financial reporting standards for state and local governments for which an ACFR is prepared in accordance with. And so GASB establishes essentially generally accepted accounting principles, or GAAP, or the framework for which the governmental financial statements are prepared under. An ACFR goes beyond what those minimum GAAP requirements are, and we'll kind of get into what going beyond those minimum requirements are. So the ACFR becomes the primary financial reporting document for governments that issue one. Importantly, it's the basis for the independent auditor's opinion. And even though auditors may spend maybe the most time looking at an ACFR, the audience extends well beyond the auditors. It's bond analysts, creditors, grantors, governing bodies, and the public that all rely on this document. And so because of that, the ACFR plays a critical role in transparency, accountability, and informed decision making. It's also worth noting under GASB 98, the term annual comprehensive financial report was established, as well as the acronym ACFR, which replaces the old term comprehensive annual financial report and that relating acronym there. So what is included in the ACFR? At a high level, the ACFR includes the audited financial statements, the notes, required supplementary information, and additional contextual information that we'll kind of get into. But overall, the report is organized into three sections: introductory, financial, and statistical section. The financial section includes the audited financial statements, notes, required supplementary information, and that includes management discussion and analysis, and supplementary information such as the combining and individual fund schedules. The MD&A, I'd like to highlight again, just is considered required supplementary information, even though it appears early in the financial section. And with respect to required supplementary information, the auditors apply certain limited procedures to RSI, but don't necessarily express an opinion on RSI. The statistical section presents financial trend data and other relevant data there, and a lot of these schedules are presented over 10 years. Not all governments issue an ACFR, but the structure and best practices are still relevant there. So we'll kind of get into that in the next slide. So even if your government does not issue an ACFR, this session is still applicable. I mean, the financial section and most best practices we'll discuss apply to all governments. The financial section being the bulk of the report. What really makes an ACFR is the introductory section and the statistical sections, which really go beyond the minimum GAAP reporting. So many governments still use just a basic annual financial report or GAAP only report that just includes the financial section there, and so we'll cover that here in this session. And it's also important to note that if there are any departures from GAAP, for example, you're issuing on a cash or a modified cash basis, those would need to be disclosed in your financial statements as well. So the Government Finance Officers Association, or GFOA, runs the Certificate of Achievement program, which recognizes governments that exceed minimum GAAP reporting requirements or issue an ACFR and apply and pay your fee to participate in the program. It emphasizes transparency, completeness, and high quality financial reporting. It's considered the highest form of recognition in governmental financial reporting, but it's important to clarify what it represents. The award is about quality of the report document, meeting the criteria within the program, but it's not a judgment on the operations or the financial conditions are perfect. So in other words, the award is not a management endorsement. The government operations and how the management is running things, definitely can contribute to the award process, but it's not a guarantee that government operations are in fact in great shape. The certificate is valid for 1 year, which reinforces the need for consistent annual discipline in preparing that. GFOA also provides valuable tools on their website that can be used in preparing the ACFR, including the disclosure checklist, which many governments use as a preparation roadmap. So the disclosure checklist provides a list of GASB requirements as well as certificate requirements that can be followed when preparing your ACFR. If you've never used a disclosure checklist, you will be amazed at how small that they can make the font. I think they make the font smaller and smaller every year. I'm constantly zooming in to read it, but that said, it's recommended to use the disclosure checklist in preparing your ACFR in accordance with to make sure you're in accordance with the Certificate of Achievement requirements. So moving into the introductory section, this section provides context and narrative, but it's also a common source of some time and consistency issues, which is, even though it's unaudited, we want to make sure that we align that closely with the audited financial information. So again, the introductory section is entirely unaudited information. Typical components include the letter of transmittal, organizational chart, and list of principal officials. If you participate in that GFOA program that we noted, you're required to include your certificate of achievement, in the introductory section as well. And then some governments also include a list of professional consultants that would be, for examples of this would be pension funds and cash and investment pools. So even though it's narrative in nature, we want to emphasize, accuracy and consistency here as critical. One of the most common issues is late or incomplete narratives. So even though you add the letter transmittal at the end of the report, doesn't mean you can't get started on that early and review the narratives there. But even if you get a head start, the date must be on or after the independent auditor's report date. So work with your auditors to determine, when they expect to issue the financial statements, and you can date it on or after the independent auditor's report date. Another frequent issue is just addressing government citizens as the intended audience at the start of the letter. When you say dear blank, including the government citizens within that when you're addressing the letter. Duplicate information already included in the MD&A is also a common issue that leads to some inconsistencies. I mean, the report is already long enough. We have pages and pages, so making sure that we're reviewing that and eliminating any duplication. It's also worth noting that the ACFR cover, just a couple other things here, is the ACFR cover, as pretty as it is, as you make your ACFR cover, you need to make sure you include the physical period, and if you're presenting comparative financial statements, both periods with the month, day, year sequence, and make sure to include the state that the entity is located in. And then within the table of contents, when you're preparing table of contents, ensuring that the titles in table of contents match the schedules and statement titles in the report. So now moving into the financial section, which is really the core of the ACFR. This is where most of the audit review time is spent, and where alignment across schedules and notes is really most critical. Financial section includes the independent auditor's report, which I won't cover in detail here since it's issued by the auditors. MD&A, basic financial statements, and the notes, required supplementary information, combining an individual fund statement and schedules. Really just the key theme is making sure you have things in the proper order, consistency within the financial statements as far as the structure goes. So the first section after that independent auditor's report is the management's discussion and analysis. And MD&A provides an overview of the government's overall financial activities. Think of it as essentially an executive summary of the financial statements. It should focus on results, trends, and changes, rather than just restating the financial statements. The key purpose being to explain significant year-over-year fluctuations. You want to make sure that your MD&A aligns with audited financial statements to just kind of eliminate the back and forth. So typically in that process, you provide a draft of your management's discussion analysis to the auditors to review, and the auditors will review for consistency and making sure that the balances and the condensed financial information you're presenting agree to the financial statements. So doing that self-review and making sure that it agrees before providing the auditors can kind of eliminate some back and forth. If you're presenting comparative financial statements, the MD&A must include 3 years of data. So just making sure that you have that third year there in addition to the current year, prior year information for comparative financial statements. And then I'll touch here kind of on some items to be mindful of that are upcoming for GASB Statement 103. I will highlight that we will be having a separate session on GASB Statement 103 coming here shortly. So I've just kind of hit some of the highlights, but GASB 103 is effective for fiscal years beginning after June 15th, 2025. So your 6/30/2026, 12/31/2026, and April 30th, 2027 year ends. One of the things that they're changing within the MD&A is there'll be 5 mandatory components, slightly changed from the existing guidance. An overview of the financial statements, financial summary, detailed analysis, significant capital and long-term financing activity, and current known facts, decisions, or conditions. Additionally, it's worth noting that the budgetary comparison information that was previously presented in MD&A will now be in RSI and in the notes to RSI and no longer MD&A. So the biggest change with 103 is really just staying within those 5 components, focusing on the why, not necessarily the mechanics of the document, and eliminating boilerplate and duplication, same as last year type of information. A couple other final tips here for preparing your MD&A. Although you want to make sure that MD&A is updated with audited numbers. You can always start early, with if you have draft balances, that's going to help you. If you can update it with draft and prior year numbers, that's going to help you identify where some of the explanations are needed for significant changes in the year. And then write it for, understand your audience and write it for an informed but non-technical reader. Focus on trends and impacts, but again, know who you're writing it for. We often, as auditors, refer the audience to the readers of the financial statements to the MD&A because of that, those trends and impacts. So the basic financial statements are divided into government-wide and fund financial statements. Government-wide including your statement of net position and statement of net activities. That should be split between governmental activities, business type activities, and component units if applicable. And then your fund financial statements include governmental, proprietary, and fiduciary funds, along with governmental reconciliations. And those governmental reconciliations at a high level are gonna reconcile your differences between what is presented in the governmental activities on the statement of net position and statement of activities to your governmental funds. So there's several different types of governmental funds. Some common examples: general, special revenue, debt service, and capital projects funds. And there's also permanent funds. Proprietary funds include enterprise funds and internal service funds. And then fiduciary funds include pension trust funds, investment trust funds, and custodial funds. GASB 103 also introduces the potential for a combining statement for any major component units presented after the fund financial statements. Kind of just add, if you have multiple component units, just adding a combining statement there. Clear presentation and proper ordering, helps us understand how these statements relate to each other. So making sure that you have those requirements. And the governmental fund financial statements are going to be split in between major and non-major funds, which I'll kind of go into on the next slide. So major fund determination is governed by GASB Statement 34. A governmental fund is a major fund if it meets both the 10% and the 5% thresholds outlined on the slide. And kind of circle back on that as kind of takes a bit of explaining to understand there. So all other funds, if it's not major, are reported as a non-major fund and combined into a single column on your basic financial statements. So any non-major funds are aggregated into a single column before the total column in your basic financial statements. We want to make sure you lock in major funds early in the process, because missing a major fund, as I've experienced, can cause a lot of rework in preparing your financial statements. So make sure you have a good handle what is a major fund, and if it's close in the threshold, closely monitoring that for late audit adjustments and reclassification entries. So circling back into the thresholds here, sorry, go back one slide, Lindsay, thank you. The 10% threshold is a fund, an individual fund that meets 10% of total governmental fund asset deferred outflows, liability deferred inflows, revenues or expenditures. And that's the key caveat here is it can be any of those categories. So if you have a fund that only meets the 10% of the assets category, assets and deferred outflows category, but doesn't meet the 10% in any of the other categories, it still qualifies under that 10% category. But it needs to be both the 10% and the 5% qualifications here. So 5%, with the 5%, you add in enterprise fund assets to your governmental fund assets and do that same calculation. You take a percentage of the fund's assets, liabilities, revenues, and expenditures in each of those categories, and percent thresholds, then it would be reported as a major fund. So following the basic financial statements, well, including the basic financial statement, the last piece of it is the notes to the financial statements. And the notes are probably one of the most, if not the most important part of the financial statements. While we have had no shortage of GASB accounting standards adding pages to our notes, they do play a critical role. So they provide detailed disclosures and accounting policies necessary to understand the statements themselves and how they're prepared. So that first note should be the summary of significant accounting policies. And the summary of significant accounting policies is the foundation, and it sets the framework for the financial statements. It describes accounting principles, the measurement focus, the basis of accounting that are used to prepare the financial statements. It also is going to provide key elections and classifications. It summarizes the fund types that we talked about for governmental funds and enterprise funds. It outlines fund balance, net position classifications, revenue recognition, major accounting judgments, and any other elections applied that are under GASB, such as capital assets and your accounting policies. So a lot that could be disclosed within there, but it's important to review that annually to make sure that information is accurate. After the summary of significant accounting policies are outlined, some of the common other disclosures include footnotes regarding cash and investments, capital assets, debt, interfund activity, risk management, pensions, and OPEB. So the disclosure checklist is kind of your guide for making sure that you've met the criteria for disclosing those. It could be a really good tool to make sure that you've met all of the criteria. And it's really important to note that the notes need to be highly detailed and cross-referenced between the actual financial statements, required supplementary information, and statistical data. So, when you're preparing it, make sure that you're comparing the balance in your note disclosure to the basic financial statements. What is, for example, capital assets, and making sure that the capital asset balance agrees to what is on your balance sheet. So required supplement information, or RSI, immediately follows the notes to the financial statements. So RSI commonly includes the general fund and major special revenue fund budgetary schedules. As long as those aren't already presented as part of the basic financial statements, they're going to be included in your RSI. It also includes pension and OPEB schedules, which are a significant component for most governments. These schedules typically include a schedule of employer contributions, schedule of changes in net pension liability, schedule of changes in OPEB, and the schedule of changes, or sorry, the schedule of investment returns. These schedules are presented over the last, the pension and OPEB schedules are presented over the last 10 years, or if you don't have 10 years, you're going to present the most recent information that you have available. And it's important to note that the information might not align exactly with the government's fiscal year end. So for example, you're presenting the most recent actuarial or valuation data that's available there. Notes to RSI are often items that do get overlooked. So some items, some examples here. So for pension and OPEB schedules, you need to disclose changes in assumptions and changes in key benefit terms. For budgetary schedules, the notes must explain what the legal level of budgetary control is and disclose situations where expenditures exceed appropriations for that legal level budgetary control. And so example of your legal level budgetary control could be at the fund level, at the department level, or even down to the account level if you want to. So GASB 103 also introduced important changes in this area. Budgetary analysis is now present, as I noted earlier in the MD&A, it's now presented in RSI rather than MD&A once you implement GASB 103. And then additionally, we've always presented an original and final budget. If you amend the budget, you have to present the original and the final budget, but now it is required to include a variance column comparing the original and the final budget, and just showing what was amended between those two. A couple less common RSI situations include governments that use the modified approach for infrastructure assets, and governments that sponsor public entity risk pool. Both have some special RSI requirements. And then from a preparation standpoint, much of the information included in RSI, such as actuarial valuations, often is available early. That's, taking advantage of that, if the information is available early, can help reduce the pressure later in the audit process by including those and updating that information within your RSI and the ACFR. So the combining and individual fund schedules follow RSI, and these schedules are supplementary information in the financial statements. They are typically presented. They're presented in relation to the auditor's opinion. So that means they're not part of the basic financial statements, but they provide additional detail and analysis. Those schedules are, really the detail that rolls up into the basic financial statements we're providing in relation to the opinion on the supplementary information there. For government applicants of the GFOA Certificate of Achievement Program, combining statements must be prepared to support every column of the basic fund financial statement. So in other words, if you have funds that are aggregated in your basic financial statements, you need to have a combining schedule that breaks out every single fund that's included within there. Common examples of combining funds are your non-major fund combining schedules. This is most common, for governmental funds, but it's also required for any non-major enterprise funds, combining schedules for internal service funds or other fiduciary funds. Again, anything that's aggregated on your basic financial statements, having that combining schedule there. It includes both your balance sheet and your schedule of revenues and expenditures and changes in fund balance schedules. And some other examples of combining schedules is, say, it's not necessarily a requirement, but if you have sub-funds, for example, you have sub-funds in the general fund that all roll up into the general fund, you can report a sub-fund that breaks out those individual funds there. Some other examples are budget to actual comparisons. So, presenting individual fund budget to actual that aren't necessarily RSI, detailed schedules for revenues and expenditures, and reconciliations from budgetary basis to GAAP basis. Individual fund financial statements should be presented in the same order that they are on the combining schedule. So, making sure that it follows the same order as the columns of the combining schedule. And there's two challenges that constantly come up in practice. The first is reconciliation and consistency. So you want to make sure that the totals in the combining schedules must tie exactly to those aggregated amounts on the basic financial statements. And then, this especially can become challenging when you have audit adjustments or classifying journal entries that are late. Depending on how you have your financial statements set up, sometimes those can easily get missed. So making sure you're reviewing that. And then the individual fund schedules often require much more granular detail. So for revenues or expenditures, you might be going down to as low as a level as the account level, and so that increased detail can really raise the risk of mapping and grouping errors if you don't review that and your controls aren't tight around that. So just making sure if you're going down to that granular level of detail that you're reviewing it, and you have practices in place to make sure that those groupings are presented properly. And so that should bring us to our second polling question. Which ACFR section tends to require the most time or revisions during audit review?
And again, friendly reminder, this is for CPE credit as well. So make sure you get your answer in.
Looks like we're about 85%. So it looks like kind of a deadlock between MD&A and the notes, the financial statements. All right, well, with that, I will pass things back over to Lindsay to take us through the statistical section.
Okay, thanks, Kellen, for walking us through the overview and kind of the core components of the ACFR. So up until this point, we've really focused on introductory and financial section, which understandably do receive most of the attention because they do contain the audited financial statements and required disclosures. But now we're going to shift our focus to the statistical section, or I'll call it the stat section the rest of the time. So while this section, again, is not audited, it is still an important part of your ACFR. It provides long-term trend data and contextual information that helps readers understand the government's financial health over time. So for many finance teams, I think the stat section can really be one of the more time-consuming portions of the report, and not necessarily because it's technically complex, but it really just requires a lot of information gathering, gathering multi-year data, ensuring consistency, and coordinating information across various departments. So over the next few minutes, I'm just going to walk you through the purpose of the stat section, some common challenges we see in preparing it, and then some practical ideas that can make the process a little more efficient year after year. So we'll start with the purpose of the stats section. At its core, this section provides 10 years of trend data to help readers evaluate the government's financial condition over time. So not just a single year, like you'll generally see in your financial statements, but this gives us that 10 years of historical data. It really helps answer the question of how has our government's financial position evolved over the past decade. So it includes trends in financial condition, such as net position and fund balance, along with revenue capacity data to show how the tax base and other revenue sources are performing. It also presents debt burden metrics, demographic and economic indicators, and operating information like staffing levels or capital asset data. So together, all these elements combined really provide a broad picture of the sustainability and service capacity of your government. It really plays an important role in telling the long-term financial story of your government and helps support transparency. It is something that your bond rating and analysis will look at, and it gives stakeholders really a perspective, again, beyond a single fiscal year end. We're look up what typically makes up the content of the stat section. So again, 10-year trend schedules covering financial position, so net position and changes in fund balances. This helps readers spot long-term patterns. It has revenue capacity information, including assessed values, tax rates, and principal taxpayers. These schedules provide insight into the strength and concentration of your government's tax base. You'll also see some debt-related metrics, debt per capita and debt relative to your assessed value. These are particularly important for some of your external stakeholders evaluating your long-term obligations. It has demographic and economic data to provide context. It includes things like population, income trends, operating information, and this really just helps reflect the scale of your government's operations. And then, taken together, looking at the big pictures, again, tells the long-term financial, economic, and operational story of your government. So again, not audited, but ends up really requiring a lot more coordination and work than you'd expect for the stat section. And a few reasons. First, the data usually comes from multiple sources. Finance, HR, administration, planning. You might even have some external providers that provide some of the information. So without clear expectations and deadlines, coordination can become reactive. Second, consistency across 10 years is essential. The value of this section, again, is in trend analysis. So if definitions change, calculations shift, or funds are restructured without documentation, you do lose that comparability. The next is structural changes, such as fund reorganizations or new accounting standards or ERP conversions. These can complicate roll forwards and historical data retrieval. These impacts need to be evaluated early to avoid last-minute revisions. And finally, the section is really highly visible. Again, your bond rating agencies, your governing board, rely heavily on these trend schedules. So errors or inconsistencies here can really affect your credibility. So that's why this stat section can really benefit from structured documentation and year-over-year validation. So given those, coordination and consistency challenges I just discussed, here's a few practices that can help improve the efficiency and reliability of the data that's being presented there. The first being assigning a single owner. Again, this data likely comes from multiple departments, but we recommend assigning one person within finance being accountable for compiling and validating the schedules. Clear ownership really helps prevent fragmentation. It really prevents having, final version 1, final version 2, final version 3 being sent to your auditors. So it helps one person compile and validate and then provide it to your auditors. Second, and I think this one actually might be the most important, is documenting your data sources. So for each schedule, record where that data originates and how it's calculated. I think that documentation really becomes invaluable if you have staff transitions or even just rolling forward the schedules in future years. I think a lot of us, we only do this one time a year and you forget where that data comes from, and then it becomes a wild goose chase trying to figure out where you got these numbers or how you calculated these items in the past. So really just increasing your documentation, below where the data is at. Doesn't need to be printed or included in your report, but just including notes to yourself for where this information comes from, I think will save you a lot of time in future years. Consider locking prior year numbers. So once finalized, historical amounts should only change for a documented reason, like a restatement. We see unintentional prior year changes a lot of the time, and it's one of the most common issues we see. It's just something unintentionally got changed, or something got changed to a 0 on accident. So locking those amounts will help avoid those types of issues. Reconcile to audited data whenever possible. A lot of these schedules do originate from the audited balances, so tying back to those figures strengthens the reliability of that data. And then finally, standardizing templates. Consistent formats with built-in formulas make year-end roll forward far more efficient and reduce annual errors. So taken together, I think these practices can shift your stat section from being this year-end scramble to more of just a structured and repeatable process. Okay, so up until this point, we've really focused on what the ACFR contains. So its structure, its required components, and its technical elements. And now I want to shift the focus a little bit to something equally as important, and that's just really how the ACFR process as a whole is managed. So in this next section, we're moving more from compliance to control. So from assembling the report itself to managing the reporting cycle as a whole. So there's 4 core elements that we have on the screen here that we believe could separate a smooth ACFR cycle from a chaotic one. And again, they're not really technical differences, it's more management differences. So the first is early planning. So early planning means anticipating complexity before it becomes urgent. So identify new grants, identify debt activity, capital project completions, or newly effective GASB standards before fieldwork begins. If these conversations are happening for the first time, during audit fieldwork, your timeline starts to compress on you pretty quickly there. So early identification gives you time to evaluate the treatment, gather documentation, and align with the auditors. Second is making sure you have clear roles and responsibilities. Every section of the ACFR should really have defined ownership, including review ownership. So whether your team drafts the statements or your auditor assists, remember that management remains responsible for understanding and approving the final report. So clarity around who prepares, who reviews, and who signs off helps reduce that ambiguity and does strengthen the controls around the preparation process. Next is cross-department coordination. As we've already discussed, finance rarely ever owns all the data required for the ACFR, which really comes into play in that step section. Information flows from various other departments. And without early coordination, the finance team could end up chasing information late in the process. And then last is ongoing auditor communication. Your auditors, you don't want your auditors to first learn about a complex transaction in the middle of field work. Early dialogue allows for smoother planning and fewer surprises. So these 4 elements, I think, would help form a good control environment around the ACFR preparation process. So once you've got your planning framework, clear and in place, the next step is translating it into a realistic timeline. And when you create your timeline, we usually start from the issuance deadline. So we start at the back and work our way forwards. And when you start your timeline, identify major milestones. So identify when the trial balance will be ready, when you'll get the draft financial statements, or when they'll be available if you're preparing them. Audit field work, governing board acceptance. So really, write out all the keys in your timeline, and each milestone should have a clear owner and a realistic timeline. I think the word realistic matters. Excuse me. So ensure you build in drafting and review time. So if your auditor assists with drafting, your timeline still needs time does not equal finalization of the audit. And I think one common breakdown is underestimating internal review. Internal review isn't a quick skim. If I send you a draft report, I really hope you don't approve it 5 minutes later. We would like you, and you should be, doing tie-outs, consistency checks, analytical reviews, confirming the narrative actually matches the numbers. Another common mistake is failing to build in buffer time for audit follow-up. Unfortunately, fieldwork is rarely the finish line. There's going to be questions, clarification, additional requests, potentially adjustments. So if your timeline assumes 0 back and forth, you're being pretty optimistic there. So realistic timeline, doesn't remove deadlines, but it's just trying to prevent compression, because once your timeline gets compressed and you have rushed reviews, that's where you have, inconsistencies that may be overlooked or required rework. So that timeline really just helps give you, visibility over the process and control over the process. So even with, strong planning and a structured timeline, there's certain pressures that impact the ACFR process. And looking at these on the screen, the goal isn't to eliminate them, because we can't eliminate these, right? I wish we could eliminate, new and changing GASB standards, but unfortunately, these are just realities in local government. So the goal is just to manage them intentionally rather than getting rid of these challenges, right? So first is reporting deadlines. Oh, you've got various reporting deadlines. The best strategy here is just shifting work earlier whenever possible. So again, rolling forward templates, updating debt and lease schedules, confirming timelines, and identifying complex transactions well before year end. The more that that's resolved before your year end close, the less compressed and stressed you feel during final field work. The next is staffing constraints. As we've seen, the finance teams are usually quite lean, and institutional knowledge often sits with maybe 1 or maybe 2 individuals. And it's not a capability issue, it's really a concentration issue. So cross-training, making sure that you have documented procedures and structured checklists really help preserve continuity during turnover or peak workload periods. The next is decentralized data sources. And we've talked about this a few times. Your ACFR does depend on multiple departments. So just having defined contacts and check-ins to improve the communication with those other departments really ensures you're not relying on a last-minute email to gather information. And then new and changing GASB standards. Unfortunately, new standards really affect just one disclosure. They can require contract reviews, policy updates, or system adjustments. So monitoring effective dates of new GASB standards early, assigning ownership, and aligning with auditors before fieldwork prevents that unnecessary compression in your audit timeline. So again, these pressures and challenges are common. It's not whether they exist, it's just how they're anticipated and managed throughout the process. So we talked about planning pressures and process challenges. I just kind of want to turn to some technical areas that often generate audit questions as well, and how to stay ahead of those. And again, these aren't competence issues, it's more complexity and judgment areas, which really just attract a little more scrutiny. So first is government-wide conversions. And the key, mitigation here for that challenge is consistency. Maintain a standardized conversion model year over year, reconcile entries back to fund statements and prior year work papers, and evaluate structural changes such as new funds or new debt early in the audit cycle. Another common technical area is capital assets. Maintain your capital assets throughout the year, maybe not just at year end. If you are relying on other departments, coordinate early. So coordinate early with facilities teams on projects. Make sure you validate your depreciation schedules before they go to the auditors. The next is debt, leases, and SBITAs. I know a big challenge here is really just identifying all the relevant agreements. So maintaining a centralized contract inventory and updating those amortization schedules before year end really helps. The next is pension and OPEB accounting. Review your reports early. Journal entries, make sure they tie directly to the actuarial schedules, and confirm that your disclosures align with the report language. And finally, fund balance classifications. Advice here is reviewing board minutes, confirming policy alignment, and performing a final classification check before issuance. So again, across all these areas, the common theme that we keep saying here is, early review and strong documentation across all of these areas. Okay, this brings us to the final polling question today. What is your biggest challenge in preparing the ACFR? Meeting reporting deadlines, gathering and organizing supporting documentation, implementing new accounting or reporting standards, or limited staff resources. Unfortunately, there is not an all of the above, so you just have to pick one of these, your biggest challenge.
Okay, I close that poll.
Okay. Meeting reporting deadlines is actually the least, 10%. Gathering and organizing supporting documentation, implementing new accounting or reporting standards, and limited staff resources all came in, 25 to 30% there. So all kind of a little bit of everything, kind of as expected there. So just a few more slides here before we close things out. So we've talked about planning risks, we've talked about technical complexity, just kind of wanted to reinforce, one message that you're probably tired of hearing me say, and it's like preparation and quality practices here. So rework is really what extends our timelines and increases stress. So here's a few practices that could reduce the friction during the audit, if you will. So the first would be standardization. Use consistent work papers and templates year over year. When formats change unnecessarily, review becomes harder and error risk increases. So standardization does allow reviewers to focus on substance rather than formatting differences. Clear cross-referencing between schedules, notes, and statements prevents having to hunt for support. Address prior year adjustments or comments. Build those into a checklist, if you will. Recurring adjustments generally are process issues, not really technical surprises. Next is consistency. Your statements, MD&A, notes, and statistical schedules should tell the same story. So inconsistencies between those can create some unnecessary review time. Next is validation. Before drafts go out, just make sure your totals agree, your roll forwards reconcile, estimates tied to source reports. So a final validation pass can catch small issues before they become audit discussions. And then an internal review. Whether statements are prepared internally or drafted with your auditor, management review remains essential. So again, our overarching theme here is simple. Kind of quality is really just built into the process you create. The quality isn't added at the end. So the stronger your preparation and review, the less rework you'll experience, and then the more controlled and less chaotic your reporting and year-end cycle will feel. So as we wrap up, just wanted to leave you with a few key themes here. ACFR preparation is more than just a compliance exercise. It reflects, transparency and financial governance, and not just technical accuracy. The smoothest reporting cycles come from structured planning, clear accountability, and proactive communication, not necessarily just larger teams and bigger budgets. Consistency builds credibility. So your statements, disclosures, MD&A, stat section should align in numbers and narrative. So you want to make sure you have a cohesive report, and that cohesive report then inspires confidence. New GASB standards and compliance requirements will continue to affect timelines and disclosures. And our biggest recommendation here is just staying ahead. Staying ahead, protects that reporting cycle. And if there's one key takeaway on preparing your ACFR, I would say it's this: it's that a strong ACFR, it's not something that's just assembled at year end. It's managed throughout the year. So when your reporting process is more treated like an ongoing responsibility rather than just a deadline event, the result you'll see is fewer surprises, a smoother audit, and stronger stakeholder confidence. That concludes our presentation today. We thank you for your time, and we hope you'll join us for the upcoming sessions in the rest of our Yellow Book series as we continue building on these and other topics.
Thank you so much. Have a wonderful rest of your day, all.